Hey all, it's Jeff. No Zoom Mondays. Welcome to those new to the channel and welcome back to those that have already subscribed. Thank you, by the way. As we know, this channel is all about retirement. I've been on a 35-year career journey and I've recently retired, and today I would like to share with you my financial blueprint so that I can highlight what I did along the way to get into early retirement. There'll be 4 topics today that I like to touch on. 1 is my money flow, 2 is money buckets, 3 is my investment strategy and how it's changed over time, 4, my investment portfolio today, its returns, and how it's going to help me fund my retirement going forward. So with that, I'm in downtown Austin. It's going to be a beautiful day. Let's go. First one is money flow. Back in the mid-'80s, I got my first software engineering job, and absolutely the first thing I wanted to do with the money that was coming in was buy a beautiful brand new Porsche. I wanted to spend $30,000 on a car that I had that I wanted at the time, and I'm so glad I didn't. I was talked out of it because that money turned into something I was able to use towards other expenses, investments, etc. But I did have a problem though, because I had all this, I had money coming in that I wasn't really educated on how to spend. And I had to read Money Magazine to figure out a healthy spend profile. And what they offer up then and still today as conventional wisdom is to spend no more than 50 cents on every dollar that's coming in through income for you towards fixed expenses. You know, whether you're renting a house or buying, whether it's a car you've bought or food and clothing, student loan payoffs, and maybe some health care, you have it. Those are things that are part of your fixed expenses, so no more than 50 cents on a dollar. You keep it lower, actually you'll be able to spend more money on the exciting and fun categories, which is 30% or 30 cents on every dollar to go towards vacations and entertainment, fun during the weeks, fun on the weekends and long vacations whenever you get them. And lastly, 20 cents, what you have left over or anything else that's not been spent, you can put towards an emergency fund, and once that's filled up, head off down the road towards investments. Money buckets. The next thing I needed to do was figure out where I was going to stash the cash that I had. First thing I did was set up a checking account to have my day-to-day funds, where I was moving money to pay bills, also to, well, now today, Zelle money, etc. The second bucket I needed to fund was an emergency bucket. Conventional wisdom says even today you should have somewhere between 3 to 6 months of your fixed expenses, we just spoke of those, in a fund, in a bucket of money that you don't touch. I've created a savings account and a bank similar to this one, and allowed myself to get at least 6 months worth of fixed expenses there. That was my first funding exercise once I saw this extra cash I had as I started my career. Third money bucket I wanted to set up and fund through the savings I had was my investment portfolio bucket. And that was where I had more and more fun. This is where returns get compounded, where you can see market returns and individual stock returns. And so I set that up. The first thing I did with my extra money though, I paid myself first, an adage I think everybody should take advantage of. The number one thing is to take advantage, if you have one, of a 401k through your company, period. A lot of times, at least the companies I worked for, they actually matched the savings up to a certain percentage of your income, and I would offer up that right away, take advantage of that match. It's free money, it's also tax-free, it comes right off your income tax. Again, a very good benefit. So the 401k is huge. As my salary increased yearly, I ended up contributing more and more to that 401k until I maxed it out. And I think the max now are $19,500 unless you're over 55, and then there's a $5,000 or $6,000 catch up. But anyway, I maxed those out, take the free money and go for it from the company that you're working for. The second area was taking advantage of buying stock, company stock, at a discount, and I did that through the employee stock purchase plans that they set up, which was fabulous, and I did it as many times as I could. I'm a long-term investor, buy it, hold it for a long time, so that I could actually make more and more returns on that stock. The third account I would fund is individual retirement account. You can also get tax benefits from that. It comes right off the top of your income. Set up a brokerage account similar to a place like the one that's in the backdrop here, and could fund it that way. I think there's $5,500 now is the limit, and higher when you're 55 or older, but definitely fund it. There is something called Roth 401k and Roth IRAs. If you have the ability to use those, if your income's low enough, I would suggest you do those as well. They're tax beneficial into the future, and our taxes are probably going to go up. So lastly, the fund I put into my investment portfolio was a taxable investment account. Again, set up through a brokerage firm like the one behind me, and that's where I was able to decide on what funds I was really going to buy and what assets I was going to put in there and increase my chances to retire early. Investment strategy. Now that I had funded my investment portfolio bucket, I needed to be able to invest. And I'll tell you, my strategy along the way has changed drastically. It went from buying individual stocks, companies, to actually just buying stock index funds and expecting market returns. And I'll tell you why. In the beginning, the individual stocks I bought ended up not doing well, and some of them ended up just actually going bankrupt, disappearing. So I lost quite a bit of money. The other thing that I found is that during the market's ups and downs, I was watching my portfolio and it wasn't handling the ups and downs as well as I would have liked. The first one that I hit was in the early 2000s. I was watching my portfolio, I felt nervous, and I also getting to retirement meant I needed to change my strategy. So in early 2000, I decided I wanted to capture a house to help diverse my investments, and also I wanted to go ahead and start investing in an index fund called the S&P 500. So I did a little bit of that. Most of my money went to the house. The other big downturn that happened was back in 2008, which we all felt, the housing crash. And that one really made me do a double click on my portfolio and my investment strategy going forward. I started looking in retirement calculators. It helped me look to see how far I was away. I did a video on that previously. I hope you've got a chance to look at it, and realized how much more I wanted to save to get to my retirement number. And two, and just as importantly, how my portfolio needed to be changed. I had a chance to read a book on investing. It's called The 4 Pillars of Investments. It was a fantastic book, and it helped me understand that not many people beat the market by picking individual stocks, and two, it's best just to get market returns through index funds, and then to allocate the money you're putting in through stocks and bonds, not just stocks. And so in about 12 years ago, it was 2010 to 11, I started to look at changing my allocation and my investments specifically across the boards through my 401k and my IRA and my taxable funds, all to match this theory of a better, more diverse portfolio of index funds, both in the stock world and the fund world. Through that book, I picked up the Sheltered Sam asset allocation profile. They talked about a bunch, but that was one of them that noted 70% stocks, 30% bonds, and with that, that's where I started to build my retirement fund that was more diverse and also helped me be more secure in this future called early retirement and what it was going to produce. Asset allocation. Now it was time to pick the actual funds that I wanted to put into my investment portfolio, as well as decide the assets asset allocation that I wanted to contribute to. And so first thing I did was do some more research, realize that Vanguard was a trusted source to buy low-cost index funds that matched the market. So I started there and I went with Vanguard. Two, I decided on an asset allocation. You have choices from 100% stock and the returns that come with stock and the risk that comes with that, or you could go 100% bonds and get return that much lower but less risk. And so I went in between that. I decided on a 70-30 mix, 70% stocks, 30% bond. So every dollar that I came into the saving bucket, third bucket, then I'd put in 70 cents into the stock fund, 30 cents into the bond funds that I picked. Given the reading I had done, it talked about stock fund allocation to go ahead and give yourself a chance to maximize your return by diversifying in the stock funds you pick. Pick the large domestic, meaning United States index fund. Pick a value fund, funds that are undervalued today but should grow faster than the ones performing today. Do that also for the small caps in the domestic market. Go from there and head towards international funds, put a % into international funds, so that you can capture, if the international market's doing better than domestic, you can capture returns, your fair share and more there. And then lastly, real estate is still a big area to make money on. You can invest in a real estate investment trust that helps you buy into commercial real estate as well as residential. So I picked a Vanguard fund to help me do that. This is my passive way to get into rental income, if you will, not having to be a landlord or anything like that. I just do this through this fund. You can see the asset allocation percentages on the stocks, and then on the bond, I went ahead and just picked one. I picked the total market bond fund from Vanguard as my fund to put money into. So that's the fund allocation. So for example, if you have 70 cents come into the portfolio and put it towards stocks, I would carve that up and then put 20% times 70 cents or 18 cents I would try to get towards the large domestic fund, and you could do the math for the rest. And I would allocate that and move my money and invest that way on a monthly, sometimes quarterly and sometimes yearly basis to make sure I got my ratios right. Last but not least, I would go ahead and take advantage of the right places to be funding each of these, the stocks and the bonds. Conventional wisdom back then was to take your stocks and put them in your taxable investment fund, which I did, and then the last one was around the bond fund and put that into your IRAs and your 401ks so you could shelter any income coming out of the bond payments in those funds, which I did. So that was the asset allocation I picked and I am currently using today. As I said, about 10 years ago, I changed my investment strategy, reallocated my funds, got into Vanguard funds just looking for market returns. So how's that allocation performed and my portfolio performed? Well, here you go. These are average annual returns over the last 10 years. This is directly from Yahoo. Vanguard, the large domestic fund I bought into for stocks, is a 14.7% return annually since 10 years ago. Go down the list, the value, large domestic value I bought into VTF, 12.2%. The small domestic, 12.8%. Small domestic value, you end up being 11.8. You get into international funds, they did reasonably well at 9.7, and then you get your REITs in there at the last at about 6.3%, all a reasonable return over the last 10 years. And then lastly, the bond fund, with the interest rates, so low, the fund didn't do as well, so it's only 3.3%. So glad to be in 70% stocks and only 30% bonds. Also really, really glad for the returns. Obviously, I'm glad I reallocated. So what does that mean my portfolio did? I have to look at the weighted average because I didn't allocate $1 to each one of these equally. The weighted average return that I received on my allocation of my funds was 9.1% yearly over the last 10 years. So again, the good news is quick math shows that return, if $1 was put in over 10 years ago, over the next 10 years to today, that would now be worth $2.4. Almost 2.5 times the money that put in 10 years ago is what you'd have today, which is what I'm seeing in my portfolio. You know, again, the good news is that has allowed me to get to my number, my spend number, 25x. So it allows me to go forward in the conventional wisdom to start taking out 4% yearly going forward and live well. Look, if I can get 9% returns in the ideal world and only spend 4%, the portfolio I have will never get consumed. You know, that's wishful thinking, I'm sure, but at the same token, by changing my allocation, my investment returns are good, and I have the ability to get market returns and enjoying that. So now that I'm in retirement, just a quick update on the money buckets. I still have a standard day-to-day money bucket for funding stuff where I move money, where I pay bills, etc. My emergency fund, though, has went and been changed due to conventional wisdom. I went ahead and increased that from 6 months to about 3 years worth of cash, if you will, in a liquid fund, in a savings fund or a money market fund in an investment firm. Why that much? Well, because the history of the market shows that all the big downturns that have happened, they take about 1.5 years, 2 years max to come back to some kind of equilibrium and forward motion on the actual market getting back to regular returns. So I went ahead and with conservative and put 3 years worth of funds there in case I hit a downturn. I can go ahead and take money from the second bucket as needed, so I don't have to take it out of the third investment bucket. Hopefully that financial blueprint is helpful for you. Beth and I are enjoying retirement. Hopefully you can get here sooner by following some of the steps we've given you, some of the stuff we did. Bottom line is we will be doing videos, additional videos on expenses in retirement, on healthcare. We'll be doing stuff on how we take money out of our portfolios and the tax consequences. So please subscribe if you see some value in any of this stuff. Like the content. If you've enjoyed the video, please like, comment, so we make sure we're developing and delivering the right content as well. Retirement is real. It's a blast. Save more if you're not in it. YOLO. Let's go.